Hello everyone, welcome to Chrisdom Investor, where you get timely, quality and unbiased opinion on the stocks and investment opportunities. In this video, I will present a comparative analysis of the top 4 textile companies using ratio analysis and different other financial metrics. This is to evaluate which one is safe to invest for getting higher returns in the future. In the end, we will estimate the CAGR to project the expected returns for a 1 lakh investment in these textile companies for a period of 5 years. These top textile companies are shortlisted based on the value investing scores. So companies such as Raymond, Arvind, Century, SRF, etc. are not qualified with their current scores owing to their bad financial results. On the top right corner of the video, I provide the link for value investing video. Firstly, the reason behind making this video is our Prime Minister Modi's recent announcement on the textile sector. His statement, "Textile sector key in realizing self-reliant India," became viral today. Addressing an international webinar on textiles tradition organized by the Indian Council for Cultural Relations, he said Indian textiles are highly valued globally and they have also got enriched with customs, craft, products and techniques of other cultures. He said the textile sector has always brought opportunities and domestically it is among the highest job providers in India. Internationally, textiles help to build trade and cultural relations with the world. Please like the video, make sure to click the subscribe button and hit the bell icon for notifications so that you know exactly when the new content is released, as I have a lot of new content coming soon. Stay tuned. Right now, comment below on what next topics you want me to cover as I look at the comments to decide what videos to make. Let us have a general overview of these top 4 textile companies. The name of the company one is Vardhaman Textiles Limited. Its share price or CMP is at Rs 809.55. Book value at Rs 1051. Market cap at Rs 4656 crores. Equity at Rs 56.52 crores. Face value at 10. Annual sales at 5902 crores. Annual PAT profit after tax at Rs 405.84 crores. Vardhaman Textiles Limited is an integrated textile manufacturer. The company is engaged in the manufacturing of cotton yarn, synthetic yarn, woven fabric, sieving thread, acrylic fiber, tow and garments. The company's segments include textiles and fiber. Vardhaman is a major integrated textile producer in India. The group was set up in 1962 at Ludhiana. The name of the company too is KPR Mills Limited. Its share price or CMP is at 660.45 rupees. Book value at 227.16 rupees. Market cap at 4,545 crores. Equity at 34.41 crores. Face value at 5. Annual sales 2,992 crores. Annual PAT profit after tax at 344.75 crores. KPR Mill is one of the largest vertically integrated apparel manufacturing companies in India. The company produces yarn, knitted fabric, ready-made garments. The name of company 3 is Page Industries Limited. Its share price or CMP is at Rs 21,422. Book value at Rs 735. Market cap at 23,837 crores. Equity 11.15 crores. Face value 10. Annual sales at 2,395 crores. Annual PAT at Rs 193 crores. Page Industries is an Indian manufacturer and retailer of innerwear, loungewear and socks. It is the licensee of Jockey International in India, Sri Lanka, Nepal, Bangladesh and the United Arab Emirates. In 2011, it licensed Speedo swimwear from Pentland Group. The name of the company 4 is Welspun India Limited. Its share price or CMP is at Rs 70.3. Book value at Rs 29.58. Market cap at 7,063 crores. Equity at 100.47 crores at a face value 1. Annual sales at 6,215 crores. Annual PAT at Rs 391.29 crores. When we evaluate the strength of the company to generate EPS for enabling strong price movement in the future, it has been found that for Vardhaman Textiles it requires to show Rs 565.2 crores profit to generate 100 EPS for the given equity and face value. Here, as a general thumb rule, 100 EPS with face value 10 makes the share to achieve Rs 1000 levels technically. If we see the Vardhaman Textiles, the existing profit after tax is at 405.84 crores. So it requires 565.2 crores to generate 100 EPS to sustain above Rs 1000 levels. KPR Mill requires to show Rs 688.2 crores profit to generate 100 EPS for the given equity and face value. Page Industries requires to show 111.5 crores profit to generate 100 EPS for the given equity and face value, which means currently the price at which it is trading is at about 20,000 crores. So you can examine accordingly. Here the Page Industries is trading far above its EPS valuations. We will learn more in the later part of this video. Welspun requires to show 10,004.7 crores profit to generate 100 EPS for the given equity and face value, which is literally impossible as on today. Generally, any company sales will play a crucial role in deciding the relative margin of profits that it can post. Pause the video and examine these metrics once again. Let us move to examine this company's growth story. We have compared 5-year revenue, EPS, DPS growth rates. Please note that ideally there should not be many gaps in revenue and EPS growth. A company that has posted high revenue and EPS growth is a more promising company to invest in. Here KPR Mill and Page Industries have both revenue and EPS growth positive, whereas Welspun has both negative. DPS growth for Vardhman and Welspun is negative. Please note that this is not dividend payout. It is the growth rate of dividend per share over the 5 years. Owing to the expansion of its product portfolio, Vardhman has started investing profits in expanding its business and dividend payout is zero in the last financial year. So the DPS growth made minus 100%. Page Industries has positioned well in revenue growth and EPS, whereas KPR Mill has stopped in the EPS growth. In this chart, we have compared 10-year revenue, EPS and DPS growth rate. Page Industries has positioned well in these three growth metrics of revenue, EPS and DPS. This is the reason why Page Industries is trading at a high price. As such, price has appreciated much due to the rise in the investors' confidence. Also, it has sustained well in both improving its top line and bottom line over the years. Let us move to examine the safety of our investment in these companies. The debt-equity ratio is high for Welspun India at 0.81, followed by Vardhman Textiles at 0.39, KPR at 0.31 and Page Industries at 0.05 for the financial year 2020-21. The trend of this metric from 2007 to 2020 can be depicted from this figure. A high debt-equity ratio is a bad sign for the safety of the investment. A company that has high debt in comparison to its net worth has to spend a large part of its profit in paying off the interest and the principal amount. If the debt is decreasing over the period of time, it is a good sign. Therefore, the companies which have a history of having taken lesser debt are safer investments. So Page is best here. The current ratio is high for Vardhman at 2.92, followed by KPR Mill at 2.09. Page Industries at 1.82 and Welspun India at 1.15 for the financial year 2020-21. The trend of this metric from 2007 to 2020 can be depicted from the graph. This ratio denotes the operating financial health of the company. It measures the capacity of the company to pay off its immediate liabilities with the immediate liquidable assets. Current assets include cash, short-term investments, receivables, inventory, etc. A current ratio of 2 is considered ideal. Companies that have a current ratio of less than 1 should be avoided. So Vardhman Textiles is best here. All these three companies have zero share pledging. Pledging the shares denotes that there is something wrong with the company, as it is usually the last resort used by the promoters to raise money. Avoid companies with more than 5% pledge. Stock dilution is one of the important factors to be kept in mind while investing. A company may be earning huge profits and may be distributing a high dividend. However, if it keeps issuing more shares, that would dilute your ownership of the company. Vardhman equity has been reduced from 63 to 57 crores. So stock dilution is negative and it can be considered as a good sign. Page is at 0%, KPR at 8.3% and Welspun at 37.5%, which means equity has increased. Let us move to examine the performance of these companies. Return on equity is the measure of the efficiency of the company at generating profit with respect to its net worth. A company that has a high return on equity is likely to grow faster in the future in comparison to one that has a lesser return on equity. It is advisable to target companies that have ROE greater than 15%. The ROE is high for Page at 41.86%, followed by KPR at 19.58%, Welspun India at 16.92% and Vardhman Textiles at 9.62% for the financial year 2020-21. The trend of this metric over the last decade can be depicted from the graph. So Page Industries is best here. However, please be noted that its price has appreciated much, that is, stock trading at 29 times of its book value. Net profit margin is the measure of how much of the company's revenue actually translates into profit after covering all the expenses, interest, tax, etc. If company A has a higher net profit margin than the company B, both belonging to the same sector, it means that company A is able to generate a higher amount of profit with respect to cost in comparison to company B. It also means that company A has a competitive advantage over company B, due to which it is able to maintain a higher net profit margin. Page Industries has a high net profit margin as compared with others. You can notice that all these companies' net profit margins are close to each other within a band of 8 to 11%. So hope you understand why I picked these 4 companies. As such, all the 4 companies are doing well. However, there are some structural differences between these companies' growth. Let us move to examine the valuation of these companies. Valuation is the analytical process of determining the current or projected worth of an asset or a company. There are many techniques used for doing a valuation. Here I have compared these top 4 textile companies with 4 valuation models such as PE, EPS, DCF, that is discounted cash flow, and Graham. A valuation can be useful when trying to determine the fair value of a stock, which is determined by what a buyer is willing to pay a seller, assuming both parties enter the transaction willingly. As stock trades on an exchange, buyers and sellers determine the market value of a stock. Discussing these valuation models are out of the scope of this video. After careful examination, we can come to a conclusion that Vardhaman Textiles is trading below the Graham's number, KPR is below EPS valuation, and Welspun below DCF valuation scores respectively. Page Industries is trading far above these valuation prices owing to high ROCE and high investor confidence in its business. Please note that Page Industries has a decent cash flows over the years. Let us compare these companies with some more key metrics and conclude this video. Vardhaman is having low PE and low price per book value (PBV) ratio, and the PBV ratio is the market price per share divided by the book value per share. The market price per share is simply the stock price. The book value per share is the firm's assets minus its liabilities divided by the total number of shares. Investors look for low PBV companies along with other metrics. All these companies scored points in zero pledging of shares by promoters. KPR scored in EPS growth, Page in debt equity ratio, and ROE, Welspun in the dividend yield. The key summary highlights in each of these companies as follows. For Vardhaman, stock is trading at 0.77 times its book value. For KPR, delivered a poor top line growth of just 5.5% over the past 5 years. For Page, good return on equity track record. For Welspun, healthy dividend payout of 17.07% and negative EPS growth. Investors need not worry as such. Once sector turnaround happens, all these will perform much better. Let us see the expected returns with the estimated CAGR for each of these companies. For Vardhaman, estimated CAGR is arrived at 23.2%. For rupees 1 lakh investment, expect a return of rupees 2,83,826. It's a low risk, high return scenario on a comparative basis. For KPR, estimated CAGR at 19.87%. For the return of 1 lakh investment, expect a return of 2,47,487. Moderate risk, moderate returns. For Page Industries, estimated CAGR at 9.85%. For rupees 1 lakh investment, expect a return of 1,60,120. Low risk, low returns. However, I tag it somewhere around a high risk scenario as well, since most of the sales are linked to the Jockey brand. So there's a lot of dependency in the future course of renewing its license. For Welspun India, estimated CAGR is at 16.1%. For rupees 1 lakh investment, expect a return of 2,10,941. Moderate risk, moderate returns. Investments in stock markets are risky. You may lose your capital partially or fully, but if you are successful with this strategy, your returns will be higher compared to the bank FD. With a strategy of splitting 1 lakh capital in 3:2:3:2, that is 30k, 20k, 30k, 20k in these 4 companies, returns can be projected up to rupees 2.18 lakhs. This is a pessimistic projection, and companies may perform far better if sector turnaround happens. Happy investing. Thanks for watching. I'm new on YouTube. If you like this video, make sure to subscribe for more. I will see you again in the next video.